Well, hello members, Ellie here. This is the weekly report. It's June 20th, the weekly report for the 18th. And what did we get last week? Some selling. We haven't seen selling in a long time, but we saw some good selling last week, especially in the small caps in gold. And as a result of what the Fed decided to do. So we're back into the range, got sucked back in, and probably going to stay there. But we'll talk about that as we go. We got a lot to cover, so let's hit it. So the big event last week was the Powell pivot. What we got is taper talk, and I don't think the market was expecting it. We saw some violent reactions as a result. It comes down to, you got to pick your poison. Either you're going to expand this economy through easy money, or you're going to fight the inflation, and you got to do one or the other. Eventually, it becomes a decision, one or the other. Fed just said, hey, we may need to fight inflation, keyword being may, and the market reacted to that in a rather violent way. So given that the Fed said we may have to do that, what does that mean? What's the ramifications? Well, first of all, the dollar just took off. I mean, you see the big spike over here, almost 2%. Tried to test fell down here, or tried to break down. Test failed twice. Fast moves come off false moves. So you break down, you don't quite break down, and boom, back the other way. This is the second test as a retest regen. If you look up here, you got the MTTFs stretched on the bearish side on the intermediate, just young on the short, also young on the long term. So what this kind of means to me is that what we may see is some sort of a larger range set up as a result of that. So in other words, you may see a range, this big or even bigger begin to develop over a longer period of time. But whatever it is, that seems to be a turn. Had it back here, now you're getting a second one. Usually that means something more significant. What else happened? Well, the short-term rates surged, so bonds sold off on the short term, while on the long term they plunged. I mean, we had a big spike up in the TLT, and the long rates went down as a result. When you get that kind of action, what you do is you flatten out the yield curve, and you can see the yield curve is starting to come down. And as we know, fast currency moves usually create equity indigestion, and that is clearly what we saw. Big sell-off, basic materials, energy, financials, etc. The only sector that escaped these losses was technology here, and the traders clearly decided that there's some sort of a rotate to that, because on a fundamental side, usually stock valuations, they use present value of a company's future cash flows, and when they look at technology, well, if you got a lower interest rate, that means the present value is increasing. And so that's a rotate to type thing. But that kind of ignores that these things are pretty well valued already. And I'm really curious to see if this continues to play out, or if we get a reversal of the reversal. The main thing is fast currency moves create equity indigestion. I've talked about that many times. And right now, the market believes that the Fed has decided that they're going to fight inflation. When they do that, when the market does that, it's going to deflate the valuations of anything that's economically sensitive, because what it's saying is that, what was, growing up in terms of economy is going to flatten out or go down. And I don't want to be in things that are economically sensitive as a result. So in practical terms, what does that mean? If you look at this latest Fed move, the winners before were value, small caps, REITs, right? All this kind of stuff. And growth was on the other end of it. And that's kind of been seen the last 2 or 3 weeks. We've seen this side of the equation start to pick up, and this side be sold. Well, we saw a huge push of that this week. It flipped it upside down. The losers used to be over here. Now the losers are the winners, and the winners are the losers. And that's what you're seeing. Energy, banks, industrials, they all got flipped around. They all got sold, which is what we just saw up here when we looked at this. And so you can see that correlation, and you can see what's happening, on the assumption that the Fed's really going to start to tighten. Now, of course, there's other views of, exactly which sectors benefit. I'm not going to dig into this, but there's, Goldman's view. They lay it out, and I've laid it out here for you so that you can see it in the middle of the road kind of stuff. The point is, though, that these are all just guides. What matters is what the market does. Don't try to tell the market what it should do. Just monitor what it does. And that's what we always try to do. And so technically, if we look at what just happened and what the market just did, what do we think the next few months are going to bring? My best guess is laid out here. And I think that there's a pretty good chance the markets are going to fall. And by fall, I don't mean crash, right? They don't have to crash. But we've been going up, 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 up for a long time. For this thing to pull back and flatten out, could be just this portion of this move. It could be a bigger portion. It could be 50% of the move. I don't know what that size is going to be, but I suspect this is what we're going to see. Because I suspect that the Fed carefully weighed what it was going to say before it said it. Now, I may be wrong, and the Fed may back that down this week because you got a lot of Fed speakers, of course, the week after. But, if we believe what they just told us and we see what the market is doing, we should expect the majority of the possibilities are either this thing's going to go sideways or down. And of course, if you've been watching what I've been saying, I've been getting pretty, conservative for a good while now. And so this really isn't news. So if we assume the market's going to go down, how much can it go down? And if you look, there was a nice table I found. I forget where I found this, but, this kind of laid out all of the, it's from Charles Kirk, had a reference to it. Good buddy of mine. It laid out all of these scenarios where, drawdowns have occurred in the market since the Great Recession. And if you look at this and just kind of surmise what happened here, 6 to 10% drawdowns are pretty common. 2 to 3 times a year they happen. So if you can kind of look from here back, there's a lot of them. And then there's some deeper ones and then some big ones, right? We haven't had a big one, actually not a big one, but we haven't had even a small one for, what is this, a long time. And so when I look at this, it's like, we're overdue. We're overdue to get a setback that's 6 to 10%. And so I would expect that probably we're going to see something like that before this is done. But the thing we have to guard against is a huge drawdown, right? One of those big, ugly ones, one of these kind of drawdowns. And so if we're looking at that and asking ourselves, what would tell us that? Well, as you already know, the answer is always in multiple swing points. It's not a necessary, but it's not a sufficient, but a necessary condition. And if you look at the S&P weekly here, this hasn't printed as a swing point low, but it will print as a swing point low after this coming week, assuming this coming week doesn't undercut it. And if that's true, that would be a break of multiple swing points if it breaks that after the coming week. That could give us some sort of a range. It could change this. So in other words, just like we saw a range back here, you could see that range that is here develop, and if it breaks, I would think this area here, and then potentially coming back to test that swing point high eventually that was never tested, would be the targets. And those are some pretty good drops. I mean, you're talking about a large percentage if it were that. And so if you're bullish, you really don't want to see this swing point low print. You want it to see it undercut this week. In other words, we just dive down this week and then we bounce off down. We create a small range up here. But do note, even if this forms and even if we do break it, that doesn't mean this market's going to, to tank. It could. That's a possibility, but it's not a high probability. It never is a high probability to get that kind of a set-off. You have to guard against it, but it's not the high runner case. The high runner case is more like this would get tested eventually, and that's probably where you'd find buyers. But that's a long way from here to here, and you got to protect against that. And so I'm not calling for a crash. I almost never do that. I learned my lesson, over a decade ago when I thought that we were going to get a crash, and then the central bankers did their thing, and everything kind of changed very quickly overnight, just like we saw last week. Again, looking at evidence of what's happening, a week ago I talked about these sector trends. This is what they look like. Just take a look here. They were almost all bullish. Well, a week later, they look rather different. You got a bunch of them that have changed, all these blue outline ones. And as I've said this before, the general rule is that if 2 or 3 of these change, usually the rest of them are going to follow. And we've got downgrades now on more than 2 or 3. And so I would expect that most of these are going to try to follow on the short-term time frame. The key is going to be out here on the weekly. Right now we've got one that has changed. If we start to see these others change, 2 or 3, then we've got a much bigger problem. And that problem would be either a long consolidation, right, with a larger range, or something bigger to the downside. But, I always give you the bad news, but you got to look at the other side too. We shouldn't get so bearish here. I mean, the NASDAQ, the NDX, they're trying to break out. Remember, the rotation to these stocks is actually pushing these stocks higher. The key this week is going to be, what do these do? Are they going to continue to break forward? In other words, is the rotation to them going to continue? Or are we going to get a knee-jerk back down to the knee-jerk up? And that, to me, is probably going to be a key this week. Because you're not going to get a serious retrace, a loss in this market unless these guys flip over. So bottom line here is that, last week I hypothesized that maybe this market may take a spill based on a Fed taper change. That is what came to pass. It's not likely to just end the bull market. The best case is the money just won't leave the market. You just push technology higher. That's what we were just talking about, in terms of rotation versus exit. But the most important takeaway now is most of the news is probably going to be bad news. You're getting these cycles where either everything's good or everything's bad. And we've been on this cycle, everything's good. And what I mean by that is like, okay, employment's lower than is expected. Well, what does that mean? Well, the Fed's going to give us more money. Market goes up. Employment's good. Oh, great. We got more business, more economic activity. Market's going to go up. When you're in that mindset, it's self-reinforcing. It's that reflexivity thing that George Soros talks about. We've moved, all news is good news. We have moved to the all news is probably bad news now, where if, employment goes down, the economy is going to suffer. If it goes up, the economy is going to suffer. It's a different scenario now. And so I think this is self-reinforcing, and if it comes to pass that this is the way it starts to be viewed, that's going to be a negative. So if we flip it around and ask ourselves, what could take the market up? Could it be earnings? It seems doubtful. I think that's probably priced in, unless they turn out to be just spectacular, which they're going to be good, but they've already discounted good. And it is probably not what they report so much as is what they say about the future. Because remember, the third quarter, that comparison is going to be a lot harder. That's when things were coming back online and companies were actually starting to make money again, right? It was after the summer. And so, I suspect earnings are not going to do it. How about rotation, right? It's possible the money simply won't leave, and so the pie doesn't get smaller. maybe a little bit of the pie goes away, but the majority of it stays there. But that doesn't take us up. That just keeps us from going down in a big way. And so I think that, probably this keeps us from falling, but doesn't move us higher. What could move us higher is the Fed reversing course, and the speakers this week saying, hey, maybe it's not that way. And this is possible. I've seen them do it before, so it's possible that the Fed kind of reverses course and says, you misinterpreted what I said. And that could roll the market again, but actually help it overall. And then there's this thing that everybody believes is the Fed just simply can't let the rates rise. And no, they can't, because that would be disastrous, actually, given how much debt there is out there. But remember, the short-term rates, in terms of this reaction, they actually rose, but not the longer term. And it's mostly these that the Fed can't control directly. And so if these are going down, that's actually accomplishing what they want. So, most important thing is that things have changed, and the wind is likely no longer at the market's back in terms of a bull market, but probably in its face. Okay, trading plan. Well, we got stopped out of a lot of positions. Fortunately, most of those still gained, and that's because we kept bringing stops up, protecting, being tight on our stops, because we were suspicious that something could happen. And that took us down to about 25% in the portfolio in terms of invested. We're down to about 9.5%. So we took a little bit of a hit on performance. But, we're really in good position. And hopefully your portfolio reflects something like this, to where, what you're doing is you're trying to follow this thing up. As the market goes up, you're trying to make sure you make gains. But you're being careful that when it turns, you don't give back all these gains, right? You're going to give back some. Unless you're not going to participate on the way up, you're going to take some losses on a turn. You can't help it, and that's okay. It's just that you don't get crushed here, and that's the way this portfolio is performing. Paul Tudor Jones said one time that you never take a winning position and turn it into a losing one, because if you do that, right, if you don't harvest those gains, you're going to be doing a financial rinse cycle. And that's basically what I was just talking about here. You've got to be able to capture those gains. You've got to manage your positions. I talk a lot on this site on the Neo. And the Neo is about the technical considerations. It's about trend. It's about timing. You've also got to do portfolio management, right? You got to manage the risk. You got to manage the positions. It takes both of these. You can't do just one and be successful. You got to do both. And that's what I try to show you on this site is, here's some ideas of things that I'm trading myself. Here's some ideas of how you can make money. And here's how to manage those things in order to make money. That brings us down to 4 positions. SLV is a loser at this point. I really should have been watching that a little bit closer. Unfortunately, I didn't, and now we've turned it into a loser. So that one, we have to find a way out, and I posted that last night when I was reviewing these. TLT turned out to be a nice buy, which kind of made up for some of the extra losses there. I'm not in a hurry to add anything here. I mean, remember, we've had a long run higher, and we potentially are at a turning point. You don't want to be buying that first dip if that first dip is a range, right? When you're going straight up and you get the first dip, that's a good buy. First buy is always a good buy. But if you've already been in a range, which is what we've been, we just try to break out here and failed. That's a fast move after a false move, right? We just saw part of that fast move, and there's probably more to come. So you don't want to be adding positions into that kind of a move. So let's let the air clear here first. Fundamentally, it's really going to be about the Fed speakers in terms of the economic events this week. if they come out and start reversing course, then that's going to be a big deal on this economic side. And so it's going to be about these speakers and what they say. On the political side, you kind of got something with Klobuchar going through that may turn out to be important if it passes this bill. And it's really targeting the big cap tech companies, right? It's going after these guys. And what it's trying to do is it's trying to make it so they can't just buy out their competitors, which is what they basically do and have been doing for years. Anytime anybody comes up with something that threatens any of these big cap tech, what do? They go eat them up, suck them into their company, and take the competition away, and make themselves stronger as a result. And this is trying to stop this. And so this bill, if it gets passed, it's going to put the burden of proof on the companies proposing the mergers rather than on the government to show that it's detrimental. It's going to put the burden of proof on the companies to show that it isn't. That's going to make it much harder to do mergers. And it's going to be targeted to just these big companies. It has a clause in there about, who does it affect, and it only affects certain mergers, and those mergers are from those big companies. It's not going to change things immediately, but if you remember, if you've been around long enough, you remember what happened with Microsoft, where they basically got broken up, or at least they forced them to break up their products and made things difficult. Up until then, Microsoft had been on a long, steady climb. And then Microsoft went into about a 15-year consolidation, and only recently has come out of that. This has the potential to do that again to all these Googles and Apples and even Microsoft again to some extent. Facebook, all of them. And that's going to be a rather dramatic change if it happens. Prognostications last week, it was worse than expected, and pretty much in line with that. Here's this week. I think it's going to be negative. I believe we're going to probably break the swing point low. We've actually already broken it, but we're going to get below it and then probably try to bounce back into it and retest it. Best case, maybe you get back up here and then roll over. Worst case, you just go down here and look at this one. And so I suspect it's going to be a tough week. Sorry this is so long, just a lot to cover. Take care. Have a great one. I'll see you next time.